Okay, so what I will do is I will present a framework that we are implementing at IFPRI, in which we are trying to resolve some of the major issues we are finding to be able to link smallholders to markets. Why is this so important is if we look into Asia, clearly there is a huge transformation. There is a declining importance in terms of grains and other staple foods, rising importance of high-value agricultural commodities. The Green Revolution has supply-led, but this transformation is largely demand-driven. At the same time, this has some implications, which means there is a change in marketing channels. There are more opportunities, but at the same time, challenges for the smallholders, and there is new roles for the government to be able to promote the way we can link these smallholders to markets. Now, what are the drivers? There are 4 key drivers, and these are very similar to what Mark presented in terms of the drivers link into the demand, which is rising income, urbanization and population growth, for sure, which is demanding more high-value crops. Outward-oriented policies. We are trying to export more and open more trade because of the structural transformation, and that is creating bigger demands and more standards. And of course, there is foreign direct investment, which is also affecting how commodities are being moved, or production is moved towards high value, but not only production, but also the demand. If we look at what is happening in terms of the growing of the consumption and production, in the left graph, you will see what is happening in terms of consumption. The brown bar is for China, the orange for Pakistan, and the yellow for all other Asian nations. In the right-hand side, you will see what happened in production. And again, in all the cases, you see that there is an increase in terms of consumption and in terms of production of high-value crops. And it's an important increase relative for staple crops, which are the first columns, which are basically negative or being reduced in terms of intensity of consumption in grains, and a significant increase of production in terms of high value, moving from fruits and vegetables, milk, eggs, and meat. Not only that, if we look at exports, we find a similar situation in which there is an increase of exports of high-value crops, and also the share of high-value crops to the agricultural exports is also significantly increasing. So what we can see is a significant pattern towards high-value crops, although with the increase of prices of staple crops in the last year, since 2007, 2008, this could have changed a little bit, but still this pattern will continue, especially on the consumption side. Now, this is come together with a growth and consolidation in the retail food markets. The market share of supermarkets has significantly increased across the different countries in the region. Not only that, the annual growth in supermarkets is increasing, and also we see growth in the food processing sector, which have increased very steep in the lately years. Now, what is happening and what are the results of that, why we need to look at this carefully? First is because the high-value commodities are perishable, and therefore you need more infrastructure to be able to move these crops and to be able to link to markets and more specific investments. So there is more requirements and more standards. And also there are some new varieties which are not familiar for small farmers. At the same time, we need to formalize links with farmers to ensure the quantity, the quality, and the timing, to transmit information on inputs and credits, and to establish trust regarding the safety and the quality of the products that you are going to be providing. And this brings into some institutional innovations, which is contract farming, for example, intensification of farmer organizations, and of course the role of the private and public sector to be able to reduce market failures and missing markets which are needed to be able to link these small farmers to the markets. Now, this is the literature that happened in terms of what was the paradox of smallholders. So during the Green Revolution, we knew that the smallholders would increase productivity, but the problem today is what is in red in the left-hand side, in your right-hand side. And basically is that the new change towards high value crops moves towards a situation in which you are no longer scale neutral. That means that you need to have some basic investment, basic specific investment. And smallholders by themselves cannot afford that. And that's the first major barrier that they are facing, because you need to cover these minimum economies of scales to be able to link them to the modern value chain. So the concept that I want to bring is how we can solve that and how we can make this value chain to flow for smallholders and not only for medium and large holders. And for that, we need to look into production, we need to look into the supply chain, in the processing, and in the marketing, and we need to look to institutional failures, market problems, and lack of infrastructure and access to technologies that they need to be able to flow these goods because of this need of having some level of economies of scale that before was not an issue And that's why the Green Revolution was so successful. So I'm going to look into 3 key problems which I think are essential. And it's a framework that we think is necessary to be able to capture and to be able to link smallholders. The first one is the importance of heterogeneity. Smallholders are not homogeneous between them. There is a huge variation, a huge difference between them. So for that, we need to identify a way to be able to capture that heterogeneity, to be able to link them to markets. The second one is how we resolve these market failures, because it's very difficult to give them at the same time access to inputs, access to credit, and access to infrastructure. So what are the intermediate mechanisms we can use through institutional arrangements to allow them to start linking so they can evolve over time? And the third one is how we scale up solutions, which is linked to the first problem. If I am able to capture heterogeneity and the different problems they face, then I can propose some mechanisms that could be from the design with a vision of scaling up the potential solutions. To look at heterogeneity, what we are trying to bring is all the different characteristics of these farmers and try to develop what we call a typology of producers, which captures the heterogeneity in quantity and quality of their assets, the soils, the agroecological conditions they face, which are different, the technologies available to them, the transaction costs to link into input markets and output markets, the credit and financial constraints, access to public goods, and the soils and the quality of the land they are working, and to see how efficient they can be with those conditions and how we can measure a level of efficiency and also the potential to which they can reach. So we bring a simple concept of economics, which is the production possibility frontier, but the only thing we vary here is instead of calling production frontier, we do a profit frontier. Because farmers, small farmers, don't produce one produce, they produce several produce. So we need to convert them into a common unit, and that's why we use profit. And we use a stochastic frontier because they are very sensitive to climate change and to shocks of climate. So it has to be stochastic. We have to incorporate that risk. And what we want to look is to 2 dimensions. One is the potential, that's the frontier, the maximum I can do with what I have access to. And the second one is the distance from where I am today to that potential. And that's what we call efficiency. So we try to measure that efficiency and that potential to be able to identify what is avoiding this farmer to arrive to the potential they could have given the conditions they have today, given the agroecological conditions, given the infrastructure they have today, the technology they have today. And we go through a process, sorry it's not so clear, but in several steps. First we look to the estimation of the frontier, we look to all the input and output prices, then we look to the characteristics to measure the efficiency, the agroecological conditions, the asset value, the socioeconomic characteristics, do an econometric model to estimate the efficiency and the potential, and based on that we can get even to the district level, because in most of the times we have very detailed agroecological conditions which allow us to define that. And that will allow us to develop, combining the soil, the transportation network, the rivers, the height, an accessibility measure that will also be a part of this typology. So we will know when it's a problem of access to markets in terms of roads, when it's a problem of efficiency because of other bottlenecks, and we will know how far they are from that potential. And then we can combine all these dimensions. So we can combine efficiency, high efficiency, with high potential. Those are the producers which are in the frontier. And the other extreme is low efficiency with low potential, when there is not too much I can do. Those are the guys that really, no matter what I do in the short term, I won't be able to move them out, because their frontier is too low and they are also very inefficient. That's where the transfers could go, the cash transfers. But in the top column is where I can learn, and in the middle 2 options, the high efficiency and low potential, and low efficiency and high potential, there is a lot of things that I can identify, and I can move forward these producers to their frontier and be able to resolve the bottlenecks. And I can, of course, look into poverty and try to prioritize based on how poor I am, if I am extremely poor in that area or the poverty is low in that area. So it's a very useful tool to target the interventions, and not only to focus in transfers, but also to look to productive projects that could allow me to move out and to link these farmers to the markets. So this can be done for different countries. I am just showing examples, but basically the colors are showing me the different types. So what is interesting here is that you have concentrations of colors. So for example, the red could be situations of very high poverty, low efficiency, and low potential. The light blue could be situations of high potential and low efficiency and high poverty. So given these concentrations of different types, that allows me to have a scaling up framework from the beginning and identify which bottlenecks I can resolve and later on scale up to the similar areas. So I don't need to do it initially in all of them. I can test solutions and then scale them up. Now, how we resolve the second problem? Once we have this typology, the idea next is to try to identify what are the solutions that could resolve, at least in the short and medium term, these market failures. And why is this so important? This is important because no matter what model we have, here I am putting two types of model. In the extreme left, you have the contract farming model with an agroprocessor, and in the extreme right, you have the most horizontal model with a farmer associations. This is an association of farmer associations. Both face very similar problems. We will normally expect that the one in the right-hand side will expect less problems than the one in the left, which is more vertically integrated. But what we found is that both of them face problems to increase their base. The processing firm will have a lot of monitoring costs to be able to bring these small producers, and they will try to avoid them and concentrate in medium and large. And at the farmer association, or the association of farmer associations, the umbrella, will also face problems to bring more producers into the umbrella because they cannot monitor quality. And remember, quality standards are very important in high-value commodities. So there are barriers to vertical integration that make it important to work with contracts because a contract arrangement could help to solve some of these problems. The product differentiation, as was mentioned earlier in the ministry, by the minister, is very important. And that's why for firms and agro-processors this is important, because they find in smallholders different types of products within the same variety. And that is what they can sell in certain niches of market. So product differentiation is an extremely important characteristic that makes it attractive also for the companies. And being a price taker and facing price variability puts significant pressure on contracts. And exploitation could also be possible because firms could have monopsony power over the farmers, and therefore they could abuse the farmers. So what we have found is that in the literature, looking to all the different arrangements of contract farming, there is a tendency away for smallholders from contractors because of too high monitoring costs, and there is a list of papers looking into this. And also we have found that there are problems for the producer that accept the contract because the company has monopsony power and could, of course, abuse the situation of the producers paying lower prices. So the idea is how to bring innovations into the designs so that we have a more equal situation. So what we can innovate in the contract designs that it can make it better for smallholders to be able to link them to the markets and take advantage of this arrangement, contract arrangement, to be able to reduce these market failures. So there are several ways we can do that. You have the problem of monitoring costs, abuse of monopsony power, price schemes, quality standards, access to credit, and productivity. Where we are looking, for example, for monitoring, club formation is a possible solution, in which the farmers by themselves, to be part of the club or to be part of the contract arrangement, they first have to go through a period of self-monitoring. This comes from the literature of microfinance. To reduce the abuse of monopsony power, we can develop strong rural farmer associations and try to make them have more bargaining power with this producer. Price schemes can be used better to be able to give the incentives for investment. Quality standards could be through a joint definition of quality. And access to credit, for example, could be a tool to do a double ransom model. So not only that the company doing the contract will give you credit, but they also will put something at stake so that you have both of them having a commitment. The farmer commits and the company commits so that you can protect against breaking the contract. So if I do a contract with a company, the company can put a collateral for a financial institution, given that they have background to do that with a financial institution. The financial institution can give the loans to the farmers, but the farmers will put their production in commitment to the contractor. And therefore you can resolve. If the farmer cheats, the bank will immediately, if the company cheats, the bank will immediately take the money from the trust fund that the company has put and vice versa. And we are testing those mechanisms and seems to be working. And also you can have clearly priced incentives for increase of productivity, which is very important. Now, in all of these designs, the concept is to try to improve into a better welfare situation, to reduce the contracts to be broken, to bring new farmers into the play, and to learn from this type of pilots so that we can later on scale them up to move them up. Let me just give you two results that we have from two types of contracts. One is price schemes, and the other one is access to credit. Basically, we implement this with a real company in a high-value crop and also in a milk-producing company in Vietnam and in the high-value crop in Peru. And as a result of these slight changes in the contracts, basically what we observe in the pies, it goes from the bottom to the top to the extreme left. The blue area basically tells you the amount of farmers that were working with the company in the treatment and the control group. And if you see the evolution to the extreme top, you will see that the blue area increased significantly in the case of the treatment group, where we were changing the incentives of the contract, putting clear price incentives for the farmer. So if they were increasing the production and the quality over one period to the other, they will get a higher price, and also give them access to this double ransom model with access to credit. So what this shows is that the contract was reinforced and the farmers continued to deliver, and there was less monitoring cost from the side of the company. In the case of Vietnam, there was a similar problem, and the problem here was there is a milk-producing company, Vinamilk, that the farmers will bring the milk to the collection center, the company will sample from the milk, take it to the lab, based on the results, put a price to the milk. The problem was that the farmers didn't trust, and they thought that the company was cheating them. And the reason was that the company was doing the test, but nobody knew what was the real result of the test. They had to trust what the company was telling them. And what we learned here is that just putting a neutral test, third-party lab testing mechanism to the farmers immediately changed the relationship and allowed the farmers to trust more and increase the investment and improve their quality. So basically what we did is agree with the company to hire a third lab company that will also take samples, and the farmers will receive vouchers that they can execute to test the quality. So if the farmer didn't trust, they can execute the voucher and the same milk will be tested. If there was a match, great. If there was a mismatch, it was a big problem for the company. So just that signal made the company change completely the system in which they were doing the test, and they completely automatized the testing. And if you look at the evolution of prices, we found an increase in the prices paid to the farmers. So it was successful in that sense, just a slight change in the contract. And finally, what is very important and normally is missing in all these designs is that we need to do impact evaluation to be able to scale up. It's very important to test if this works or not. And for that, we need to have a very good design. That doesn't mean a lot of money. It means to do a good design so that we can test it from the beginning, and that will save a lot of resources to help to identify the causal link, and that these changes in contracts and designs, in innovations in farmer associations could help to link and promote accountability. And that allows us to later on be able to scale up this solution and go back to the typology and identify the areas with the similar problems so that we can scale them up to those areas. So finally, the idea here is that we think that the first problem can be resolved with this typology, this kind of a stochastic profit frontier that looks to potential and efficiency and look to the problems. We can resolve market failures, at least in the medium and short term, using contract farming or farmer association arrangements. Later on, of course, there has to be a bigger role of the government and private sector, but at least this could resolve several of the problems because the big companies and a strong farmer association could resolve those fixed costs and economies of scale. And impact evaluation is central to be able to scale up these solutions. Thank you very much.